All right, good morning. This is David from Trader Dale's, and today we're going to go over a extension trade using the initial balance, which we really like to use here at Trader Dale. Okay, now for those of you who don't know what the initial balance is basically taking the first hour of the New York trading sessions from 9:30 to 10:30 and marking out a high and a low. That's it, and a midpoint. As you can see, I have a tool that does that for me, marks the high in red and green, the low in red, and tints that area so I can go back and look at it and gives me a good visual. So what we're looking for the initial balance is we're looking for a extension and acceptance of price above or below, because after 10:30, that's how we're going to know if price is going to be trending for the rest of the day after the first hour, or are we going to really just stay in balance for most of the day? And that's really the only two things that the market can do after the first hour. It's either going to stay in balance within that first hour after trying to attempt to break one side or the other, or it's going to break one side or the other and extend and continue lower. Okay, so this is an example of an extension trade. So what are we looking for? Something very simple. So I have the NQ and the ES together because we have to watch both, because both markets give us an idea. And we're also looking for divergences in SMTs, which are very important in our trading. Okay, so the first thing we're going to look for is a 15-minute close. Okay, a nice 15-minute bearish close below the initial balance. Okay, it can't be a rejection candle. It can't be something that rejected out and closed nearby. It has to be a clean bearish candle closing below on a 15-minute chart. Okay, now what we're looking for next is not only a close, but a displacement below. A displacement means leaving a fair value gap behind. Okay, because that shows intention. We want to see intention of acceptance of price below this, because that's going to give us our targets. Okay, now once we have that, okay, and we're going to use this on a 15-minute chart. Now, sometimes you can use it on a 10-minute chart or go up to a 20-minute chart. Okay, doesn't really matter, but we don't want to use anything really less than that, because anything less than that, then the conviction is not going to be as strong. And anything higher than that, let's say in a half hour or an hourly chart, is just going to be too long. So the 15-minute is the perfect sweet spot. And occasionally you can go to a 10-minute if there's no 15-minute, because sometimes there will be a 10-minute and not a 15-minute. Okay, and that's all you really need. Anything less than that is going to be too short of a time frame. So as you can see on the NQ, we've displaced lower and we've created a fair value gap. Now, the next thing we're going to look for is price to tap back into that fair value gap. Okay, and while doing so, create an SMT. So as you can see, price here did not tap into the fair value gap, but the corresponding candle of the ES did break this high, even though the NASDAQ didn't. So that's good enough, because the ES did it and not the NASDAQ. So that's an SMT. All right, so now we're going to need an execution. So let's go to the shorter term charts. Okay, so now, okay, let me just spread this out a little bit. On the right is the NASDAQ, on the left is the ES, because obviously we're using the ES for reference. So here is that SMT back into the 15 minutes. So what are we looking for after that? First of all, we're looking for a bias, which is bearish, a narrative, which is a pullback into that fair value gap with an SMT. And a narrative is just an area where, hey, if we're bearish, where can we deliver from? And that's the exactly level. And now we just need an execution, okay? And if you go to the, in this case, the 1 minute time frame, okay, after we had the SMT, we created this bullish fair value gap that got quickly inversed. Okay, now these three blue lines are the draws on liquidity. Okay, so we don't need to go for the entire move the first time. What we're looking to do is two things. A, we're looking to take out this external liquidity right here, at least, where we can at least go break even. Okay, and then we're looking to trade into that level. Okay, so the trade's going to look like this. The short is going to be on the close of that candle, and our target is going to be that level here for about a 1.75 risk to reward trade. Okay. The reason why we do this and take those prep, because especially after 11 o'clock, price can get choppy. And every time we hit these levels, you're going to get reversal traders, and they're going to, that are going to try to inverse, and they're going to try to induce more buyers earlier after taking before they do take price a little bit lower. So we always play target to target, let it bounce, and then we re-enter the trade and then target the lower ends. And that's exactly what happened about 45 minutes to an hour later. Okay, we rallied, we moved higher, we created another SMT, okay, and then we had a nice inverse fair value gap on the 2-minute V formation, taking out this bearish move, okay, and in this case, we're going to do the same thing because we have not drawn to these lower liquidity levels yet. We're going to short right at the close. Our stop is going to be right above that candle that swept and above the fair value gap. And now we're going to target these lower levels. So this was a better risk to reward trade, 2.75 to at least the first level. Okay. And if you took it to the second level, it was 3.66. And as you can see, the fourth level that we were looking for never hit during market hours. It eventually hit, but not during market hours. Okay. So usually we will take this to the next level right here. So let's call this a 2.75 risk to reward. Okay, and as you can see, we had a little bit of a pause when we got there. We could have easily bounced from here. We didn't, but then we obviously went to that next target. Okay, that's a decision that you obviously can make once price gets there. But typically when I've got two levels so close to each other, I don't get piggish. A 2.8, 2.75 risk to reward trade is an excellent risk to reward trade, considering we just did a 1.75 on the recent trade. Okay. Very simple setup. It has to do with the initial balance. You can put these on your charts. This is the one I use. There are multiple ones out there that will mark it for you. You can also mark them yourself by marking out the highs and the lows. And basically what you're doing is you're looking for an expansion below. Okay. And this is going to happen more in trending markets. Obviously, the past couple of weeks, we've had a lot less of these plays because the markets have not been trending. But when we're in trending markets, you get a lot of these plays. And this is a great example where you can get some extension moves. And this is where a lot of money is made because these are big moves. You know, you're with the trend. You have confirmation that the trend is lower because you're expanding below initial balance. Okay. And then all you need to do is look for reasons and targets for price to go to once that happens. But as you can see, once price did this, there was a very strong move to the downside here. And a lot of money can be made, not only in one trade, but possibly two trades heading into that level. Okay. So trying this on your charts, back test this a little bit. Again, you're looking for the 1030, after 1030, the initial balance, high or low being broken. Okay. And then a continued move to the downside. Let's, before we leave, let's just kind of find other example. So here's another example where the NQ displaced above the initial balance high. Okay, and now we can play this to the upside, to targets to the upside. Now, one rule is that once we do break initial balance high, no more shorts for the day, especially when we're above initial balance high. Same thing with initial balance low. Okay, once we hit initial balance low, the shorts are off the table. Okay, now we can fake the move down into here and rebalance a little bit, but these are retracement trades that can be very difficult. This is an example where we tried to break out and then pulled back to the midpoint. In this case, we reversed, which is even rare. Okay, but we're looking for expansion. So typically after 1030, once the high or the low of the initial balance has been hit, we are not counter trend trading anymore, and we're looking for an expansion to move higher or lower. Okay, put these on your charts, back this to yourself, retest it. You're looking for a 15-minute move, then go down to a short-term chart, 30-second, 1 minute, 2 minute in that range, and look for either your entry model or the entry model that we use, which is basically a inverse fair value gap with SMT divergence. And if you want to add a change in state of delivery for confirmation, you can do that as well.
Hey everyone, it's Dale here. I hope you enjoyed the video. If you like to trade alongside me and our team of prop firm funded traders every day, then click the link below the video and hop aboard. We are looking forward to trading with you.